Utilizing candlestick signals in conjunction with the T-line provides a very powerful high probability result for investors. And you don't have to be a sophisticated technical analyst to take advantage of candlestick signals. The signals are based upon 400 years of identifying what happens in investor sentiment. An evening star signal in the overbought area. We're in an uptrend. The pullback comes to the T-line. Buy signals. An evening star signal in the overbought area comes back to the T-line. What finally changes this overall uptrend? The fact that you have an evening star signal and a close below the T-line. Now the trading analysis becomes very simple. You can stay short until you see a candlestick buy signal and a close above the T-line, with the caveat that the further away you move from the T-line, the higher the probability it's going to come back up and test it. As seen at the 200-day moving average, which everybody else is watching, we had a bullish doji harami telling us the selling had stopped. A little inverted hammer, bullish confirmation. So if you were short, you had a good spot to start covering your short positions. But was this a reversal or a bounce? As can be seen, once it came up to the T-line, the next day they did a doji below the T-line. What's the simple rule of the doji? Price is usually going to move in the direction of how they open after a doji. It opened lower, telling us we weren't going up yet. Notice what's happened over the last few trading days. The T-line has acted as resistance. What makes that a more relevant factor is that nobody has the T-line on their charts. We can see much more plainly that the T-line is a natural resistance level or a natural support level. That same scenario can be applied to analyzing the Nasdaq chart. At the same time the Dow was selling off hard, the Nasdaq did a little doji gap down, our best friend signal, telling us there's strong selling. Once again, in the 200 moving average area, they bounced up. They did a hanging man, traded lower. We're still trading below the T-line. Is this basing, or are we in a bearish J-hook pattern? That we don't know. However, we do know that if we've got short positions on, we remain short until we see a buy signal and a close above the T-line in those specific positions, as well as the market indexes. There will always be stocks going up when the market's going down, and that is plainly illustrated by the strongest of the candlestick signals, such as the kicker signal. Kicker signal opens here, closes here. The next day, they gap up at or above that open and go the opposite direction. Notice what's happened in the last couple of days on TCP, one of our recommendations, based upon the strength of that kicker signal. Now, not only do we have a kicker signal when the market's heading down, but today with a positive trading, we've got a bullish doji sandwich telling us the 50-day moving average was not going to act as resistance. Where's our next kind of calculated target? Probably up here at the 200-day moving average. Another position that we recommended was IDT. Best friend signal, selling off. Now we've had a doji, inverted hammer, bullish confirmation off the T-line and above the 200, setting up nicely for a J-hook pattern. And note what this pattern was illustrating even when the market was very soggy today. Remember, the patterns are based upon the accumulative knowledge of investors coming into a situation or into a position. So if it's the accumulative knowledge and they know the market is selling off and they're still buying, that means they've made their decisions based upon other parameters. But going with the flow of the market, we know we can stay short on positions that have provided very strong sell signals. Our recommendation to go short on Winnebago was based upon the big bearish belt hold signal, followed by bullish or bearish confirmation below the T-line. All we have to do now is stay short until we see a buy signal and a close above the T-line. We've got a few of these positions on that are working well because we can see the overall market is not in a bullish direction, it's in a bearish direction. That'll be it. We'll see you in the chat rooms.